There is a hidden harmony in trending markets, and there are specific reasons why trends behave the way they do and why trend waves form the way they do. The best way to understand trending markets is by looking and using Fibonacci's because they show us the percentage. For Fibonacci, we're always looking for an ABC move. A is the initial impulsive wave, B is the first pullback, and C is then either called the extension or the continuation. And behind this rhythm, there's usually a very specific ratio. We use the Fibonacci, we measure the point A to point B. In Fibonacci, this is our reference trend wave, where we refer to it as 100%. The corrective wave goes against the initial trend. It is shorter than the initial move. Usually the pullback ends somewhere between the 61, 50 or 38 retracement. Very typical to see a reaction precisely at one of the Fibonacci levels. One of the most fascinating things is that the continuation afterwards into the Fibonacci extension is usually going to 161 or 50. This is a very precise rhythm, and we will be able to observe this very often. And there's obviously a reason for why markets behave the way they do. To get this trend going, we have a specific amount of buying power here. The buyers are in major surplus and we don't have a lot of sellers. That's why the market shoots up. We have a pullback against the initial trend direction, but we don't make it all the way back to the initial trend origin. This shows us that currently we do have more sellers. We don't have more sellers than buyers, as otherwise we could have covered the trend origin. This then makes the continuation more likely since we are in a buyer-dominated market. The selling pressure is only temporary, and because the initial trend wave is longer than the pullback, we can estimate with relative certainty that a continuation is likely to happen. But it's even more fascinating. Within those big trend waves, we find smaller trend waves. For example, here we have an A pattern, B, and a C pattern. Let's get rid of all this. This is what I was referring to, A, B, C. Let's apply our Fibonacci to this pattern. We drag it from the point here to the origin. We can see we have almost a perfect 61 retracement here. We overshoot 50 a little bit, come quite close to 161, and then this is where the trend continuation ends. So within the big trend waves, we find this micro pattern over and over again. We could even zoom in further and look at the trend waves within the trend wave. This is the pullback within the bigger pullback. We can find the same rhythm here. Fibonacci from here to here. When we zoom in, you can see we have a 50 retracement. We make it to 161. Before then, we resume into the bigger picture trend. And this pattern is going to repeat itself over and over again. We can look at this pattern from point A to point B here. Then we have our 61 retracement. And now we make it to 138. We miss 150. And then we go over into a distribution. There's a reason why late in a trend we often don't make it to 150 or even 161. The reason is that we have already completed our so-called Elliott wave count. On average, a big picture trend goes on for 5 trend waves. 1, 2, 3, 4, 5. After 5 trend waves, on average, a trend has exhausted its potential. The last trend wave is often the shortest in all the previous trend waves. The third trend wave here is usually the longest. The first pullback is often the deepest, since we're just getting started and we probably still have some buyers and sellers left here from what has happened before. The fourth trend wave is usually the shortest pullback, because now we are in the major trending phase. Now, after the trend wave has been completed, we are in a distribution pattern, we move sideways, and then the market has to figure out where it's going to go next. Once we have our first impulsive trend wave, like here in the beginning, we can then use our Fibonacci tool again to anticipate the new trending waves.